Lately, a lot of dividend investors have been sweating over ULTY. The fund's been sliding, and panic is setting in. Some are cashing out, others are asking the big question: what's next? If that's you, take a breath, because in this video, I'm breaking down 8 dividend ETFs built for stability, strong yields, and long-term holding power. These aren't risky, hype-driven plays. These are income workhorses that can deliver consistent cash flow without eating away at your original investment. One of them even pays every single week. So if you're looking to rebuild confidence after ULTY stumble and you want safer, heavier, more reliable options to anchor your portfolio, this list is for you. If you enjoy this kind of content, don't forget to like, share, and subscribe. It helps us reach more investors like you. Quick reminder, this video is not financial advice. Investing in stocks is risky. Always do your research before making any decision. All right, before we jump into the list, let's clear up what NAV erosion really means. In plain English, it's when your fund's net asset value, basically the worth of your initial investment, slowly decays over time. Imagine parking $10,000 into a fund, and a few years later the chart shows $7,000, even though you've been collecting dividends. That's erosion. Now, fund managers don't love the term because sometimes it's just the market pulling everything down. For example, option-based ETFs can look like they're eroding, even though total return with reinvested dividends is actually positive. The key takeaway? Always look beyond the price chart. NAV erosion is less about scary numbers and more about whether the fund matches your investing style. Do you want pure cash flow, or are you playing the reinvestment game? With that foundation set, let's dig into the ETFs. All right, first on the list is Defiance Russell 2000 Target 30 Income ETF, ticker symbol IWMY, and I'd call this one a bit of a hidden gem. You don't hear it talked about as much as the bigger names, but it deserves a spot in the conversation. Here's what makes it stand out. The dividend yield is an eye-catching 14.4%. That's massive compared to what you'll find in most ETFs. Now, it does come with a 0.68% expense ratio, which isn't exactly cheap, but plenty of investors are happy to pay it because the yield more than compensates. Now let's clear up a common misconception. If you pull up the chart, you'll notice the share price hasn't exactly been soaring. Some investors see that and immediately cry NAV erosion. But in reality, that's not what's happening. This ETF is tied to the Russell 2000, which focuses on smaller U.S. companies, and small caps naturally take bigger hits in rough markets. The fund is simply reflecting what the Russell itself is doing. So while the price can look choppy, the consistent income stream is what makes IWMY attractive. If you're reinvesting dividends, the total return can actually look pretty solid over time. And if you're collecting the cash, well, that yield speaks for itself. Bottom line, if you want exposure to small caps, don't mind a little volatility, and love the idea of double-digit income, IWMY is a strong candidate. It may not get the spotlight like S&P 500 or NASDAQ income funds, but for dividend-focused investors, it can be a real workhorse in the portfolio. All right, let's talk tech, because love it or hate it, the tech sector has been the engine of the market for over a decade. And IQQQ, the Proshares NASDAQ 100 High-Income ETF, is one of the cleanest ways to tap into that. This fund is tied directly to the NASDAQ 100, which means you're instantly getting exposure to companies like Apple, Microsoft, Amazon, and NVIDIA, the giants that have been driving innovation and returns year after year. Now, the numbers here are solid. The dividend yield sits at about 13.3%, and the expense ratio is just 0.55%. That's a pretty attractive balance. You're collecting a double-digit payout without bleeding too much on fees. Of course, there's a trade-off. Because it's tech-heavy, you should expect more ups and downs compared to S&P 500 income funds. When the NASDAQ rallies, IQQQ shines. But in a rough tech sell-off, it's going to feel the pain. The key is understanding that this ETF thrives when innovation stocks are in favor. Here's why I like it. While many high-income ETFs are built on broader indexes, IQQQ lets you target the sector that's been delivering outsized returns for years, and it layers consistent income on top of that growth exposure. It's essentially a way to get the best of both worlds: participation in tech's long-term upside while cashing checks every month. So if you're bullish on the future of tech and you want your portfolio to not just grow but also pay you as it grows, IQQQ is a fund you'll definitely want on your radar. This next dividend ETF is a lot more steady. I'm talking about Proshares S&P 500 High Income ETF ticker symbol ISPY. This ETF is tied directly to the S&P 500, which means you're getting exposure to the biggest, most established U.S. companies, the Apples, the Microsofts, the Johnson & Johnsons of the world. It's essentially a way to tap into the backbone of the American economy while still collecting a solid income stream. Here's the breakdown. The dividend yield sits at about 11.8%, which is comfortably in double-digit territory, and the expense ratio is 0.55%, making it cheaper to hold than many of the higher-yielding niche ETFs. The real selling point of ISPY is balance. Unlike tech-heavy funds like IQQQ, this one spreads risk across all 500 companies in the S&P, which means you're not overly dependent on a single sector. That makes it less volatile. You're not going to see those big, gut-punching swings when tech stocks dive. Instead, you get steadier performance with income that keeps rolling in month after month. Now, is ISPY the most exciting ETF out there? No, it's not designed to be. But for long-term dividend investors, that's exactly the appeal. It's consistent, it's diversified, and it's reliable. Think of ISPY as the anchor position in an income portfolio. It may not grab headlines, but it helps keep everything grounded. If you're looking for dependable double-digit income without the roller coaster ride of more concentrated funds, the ISPY is a strong choice to consider. Now let's shift gears to something a little less traditional. The wild card of this list. Amplify Bitcoin Income ETF ticker symbol BITY is an income ETF that launched earlier this year, and it's tied directly to Bitcoin. And let's be honest, the first thing everyone notices is that monster yield, 24.6%. Yes, nearly a quarter of your investment coming back to you in annual dividends. That's the kind of number that makes investors sit up and pay attention. On the cost side, the expense ratio is 0.65%, not the cheapest, but not outrageous either, especially considering what you're getting. Here's the catch. This isn't your standard steady and safe dividend ETF. Bitcoin is famously volatile. If Bitcoin keeps pushing higher, BITY could deliver eye-popping returns on top of its dividend payouts. But if Bitcoin crashes, this ETF is going down with it fast. And that isn't NAV erosion in the traditional sense. It's not the fund structure breaking down. It's simply the reality of being tied to such a volatile asset. So who is BITY really for? It's for investors who believe in the long-term story of Bitcoin, who see crypto not as a passing trend, but as an evolving asset class that will continue to grow. If that's you, BITY gives you a way to not only bet on Bitcoin, but to collect income along the way. But let's be clear, this is not a buy it and forget it type of ETF. It's high risk, high reward, and absolutely not for the faint of heart. For some, it could be an exciting satellite position in a portfolio. For others, it might feel too much like gambling. Either way, BITY earns its spot here because no other ETF on this list offers such a unique mix of crypto exposure and massive income. Moving ahead, NEOS Gold High Income ETF ticker symbol IAUI. This really stands out as a gold-based income ETF. For as long as people have been investing, gold has carried the reputation of being a safe haven. When markets crash, when inflation spikes, when currencies wobble, gold is where investors run for cover. But here's the twist. Gold doesn't usually pay you anything. You hold it, it sits there, and maybe it goes up in value. That's it. IAUI changes that game completely. This ETF gives you exposure to gold while also delivering a 12.3% dividend yield. That means you're not just sitting on an asset for protection, you're generating real monthly income from it. Now, there is a trade-off. The expense ratio is 0.78%, which is definitely higher than most stock-based ETFs. But that's the price of accessing a strategy that blends gold's defensive qualities with an income engine on top. And here's why that matters. In times of uncertainty, whether it's inflation, geopolitical tension, or just market volatility, gold has historically held its value. With IAUI, you're not only getting that hedge, but you're getting paid along the way. There aren't many funds that combine those two worlds, gold stability and consistent cash flow. That unique angle makes IAUI an interesting diversifier for any income-focused portfolio. It's not about replacing your stock ETFs. It's about adding another layer of protection with a paycheck attached. Real estate has always been one of the most powerful ways to build wealth. But let's be honest, not everyone wants the headaches that come with it. Tenants, leaky roofs, late rent, property taxes, legal disputes. It's practically a full-time job. That's where IYRI, the NEOS Real Estate High-Income ETF, steps in. It gives you exposure to the real estate market without ever having to pick up a hammer or call a plumber. And the best part? It's not just exposure, it's income. Right now, IYRI is throwing off a dividend yield of over 11% with an expense ratio of 0.68%. Yes, that fee is a little on the higher side, but NEOS funds are known for squeezing more income out of their strategies, and investors usually find the trade-off worth it. The real strength of IYRI is diversification. Instead of tying your money to one property or one REIT, this ETF spreads your risk across a basket of income-generating real estate assets. You're not betting on flipping houses or watching property values tick up, you're simply collecting a steady stream of cash flow. Now let's be real. Real estate moves in cycles. When interest rates rise, property values can soften. But that's the beauty of IYRI. You're not banking on appreciation. You're banking on consistent, high-yield distributions, while the fund managers handle the heavy lifting behind the scenes. So, if you've always liked the idea of real estate income but hated the idea of being a landlord, IYRI is a hands-off, income-first way to make real estate work for you. Next is JP Morgan Equity Premium Income ETF, ticker symbol JPI, and this one has been a crowd favorite for years. It's one of JP Morgan's flagship income ETFs, and for a while, it was even among the most heavily bought dividend funds in the market. The dividend yield sits at about 8.5%, which is healthy, though not as eye-popping as some of the newer competitors. What really makes JPI attractive is its low expense ratio of 0.35%, less than half of what you'll pay with some others. That means more of your money is working for you instead of going to fees. Now, JEPI has earned its reputation as a steady, reliable payer. But here's the truth: compared to some of the newer, higher-yielding funds, its total return feels a little underwhelming today. It's like the old reliable car in your driveway. It still runs great, it's dependable, but it doesn't have the flash or the horsepower of the latest models. Still, for conservative investors who want lower fees and a brand name they trust, JEPI continues to hold its ground. And finally, let's talk about the star of the show, Roundhill Magnificent 7 Income ETF, ticker symbol MAGY. This fund is built around the Magnificent 7: Apple, Microsoft, NVIDIA, Tesla, Amazon, Meta, and Alphabet. Instead of writing options on each stock individually, MAGY writes them on the Roundhill MAGS ETF, which already bundles those 7 giants together. That means if one of the stocks stumbles, the others can balance it out. Here's the kicker: a 35.6% dividend yield. Yes, it's enormous, but the expense ratio is 1.28%, making it the priciest ETF on our list. The question is whether the weekly payouts, and yes, this one pays every single week, justify that cost. If you believe the Magnificent 7 will continue leading the market, MAGY is one of the most exciting ways to collect income along the way. Just be prepared for some swings, since it's concentrated in only 7 stocks. Now I want to hear from you. Which one of these caught your eye the most? The stability of ISPY, the monster payouts from MAGY, or maybe the Bitcoin play with BITY? Drop your thoughts in the comments. And remember, this is not financial advice. Always do your own research before investing. If you enjoyed this breakdown, make sure to like, share, and subscribe so you don't miss future videos. Thanks for watching, and I'll see you in the next one.